Avon Resources Limited is a gold exploration company with significant projects in British Columbia and the Yukon. Trading on the TSX Venture Exchange, symbol ABN, and the OTCQB, symbol ABNAF. Surrounded by world-class gold deposits and mines, Avon's 23,000 hectares Forest Kerr Gold Project is located in the heart of the Golden Triangle in northwestern BC. For more information, visit us at avonresources.com.
You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is home ownership consultant Ross Kay from wealthyhomeowner.ca, Canada's authority on home ownership. Welcome back to the show, Ross.
And thanks for having me back, Jim. Happy October.
Happy. Ross, Joanna from Kingston, Ontario asked us, I've heard CMHC warn Canadians that house prices could fall up to 20% based on the latest prices from August and September. Is that possible, and what fallout would result?
Is it possible? Yeah, so it's just possible. I can create a 20% house price drop without the price of houses dropping at all. So that's how possible it is. We've got reported today house price changes in the city of Toronto. I think they're claiming they're up 14% or something crazy like that. You're having it report across the country that house prices are up astronomical numbers in some parts of the country where you've never seen house prices rise before. And that's because house prices don't change. All that changes is the composition of buyers that are active in a market in a month. So when CMHC put out their warning a couple months ago, and they gave that range, I think they went from between 8 and 18%, something like that, or 8-12%. And then you think in the meantime, what's been reported across Canada as house price gain, this lady's calculations would be correct. You need to be around 21%. The worst case scenario is CMHC's forecast. Everybody is laughing at CMHC's forecast right now. I'm watching housing pundits, housing analysts, realtors across the country, economists for that matter, laughing at the CMHC for making these statements. Well, they can laugh all they want. I can create a house price decline of 20% without the actual price of a single home dropping a penny. I can do that the same way as we know house prices from April of 2020 at $488,000, the average sold across Canada in the month, and the $586,000 reported in August in Canada on average across a month never actually happened. It was simply a change, a compositional change in the wealth of the home buyers that was buying in that month. And what that means is, Jim, the 5 categories, the 5 price points that we are monitoring across Canada, because there's 5 links in the sales chain, you can use the same 5 price points, and you can go from $488,000 to $486,000. And each month in between, the change can be properly recorded and logically seen to the average person, even someone with no experience in a housing market. And you could show them how the sales progress through the chain, and people would say, oh yeah, that makes sense. And then you would show them each month, April, May, June, July, August, now September, how those changes in the share of sales resulted in the average purchase price or average house price that the Canadian Real Estate Association report. So I'm telling this lady that I can show you a 20% house price change just by sales going back to the way that they were at the beginning of this cycle. So the proportion of sales in each link, the groups of buyers buying a first-time home, second-time home, third-time home, fourth-time home, fifth-time home, being back to what it was at the start of the cycle, price return to what it was then. So there's your 20% house price change. What people don't understand, Jim, is what that means, what that actually means to people, families, the greater Canadian economy, and a recession. And this is what it means. Right now, if we take a 20% drop of what the sale price is going to be reported as this September from the Canadian Real Estate Association, and we accept that everybody in Canada believes Korea, every economist in Canada believes Korea, every housing analyst in Canada believes Korea, every bank economist in Canada believes Korea, and every newspaper reporter in Canada believes Korea. If they all believe Korea, and we have a 20 in September, and we have the 20% house price drop that would be a consequence of the CMHC forecast. The average wealth of 80% of the homeowners in Canada would fall by 50% or greater. Let me say that again. If CMHC's prediction was true, based on what the Canadian Real Estate Association is going to report this month, and a 20% reduction takes place in the average price, when those families, 80% of the homeowners in Canada, went to the bank and said, hey, I want to borrow against my home, they would find that they can borrow way, way less because their wealth in their home equity is now dropped by 50%. Because you have to understand, folks, when someone is carrying a mortgage, they have let's say that they own a $500,000 house, but that they have a $200,000 mortgage. That means they have $300,000 worth of wealth. Well, if a $500,000 home drops by 20% in value, that means they go from $300,000 of wealth down to $200,000 of wealth. Or, that's a drop of 33%. It was a 50% increase, but now it's a 33% decrease. The consequence of that is that those people no longer can borrow money. They can't leverage their debt. They can't go back into the bank and borrow money against their house, even renewing a mortgage. All of a sudden, the bank will look at that situation differently, because the equity to debt ratio is totally different. So, what the bigger question, what CMHC failed to report in their forecast, is really the drop in wealth that gets recorded and the consequential impact on the economy. Because when your wealth drops, you stop spending money. That's the nature of the Canadian family. It's been the way that housing data has shown Canadian families spend now for, since the 1980s. There's a direct correlation between the two. So you can imagine trying to re-stimulate the economy in the middle of a recession while housing prices, when home ownership wealth is dropping. It doesn't work. It doesn't happen, which is why we worry about the recession. So, Joanne in Kingston, yeah, you're 100% right. We can create a 20% house price drop without the price of houses dropping a penny. But we also know in the following year, everybody is going to believe that house prices drop 20%. And it's at that time, that amount of lag, where the reality of house price illusion is home. Because you no longer have the wealth that you can walk into the bank and extract in one way or another.
We'll have more with Ross Kay right after this.
Engineer Gold Mines is focused on the exploration and development of the historic high-grade Engineer Gold Mine situated 32 kilometers southwest of Atlin, British Columbia. Engineer Gold Mines is fully permitted for surface and underground exploration with the drill program now underway. Engineer Gold Mines Limited trades on the TSX Venture Exchange, symbol EAU. For more information, please visit us at engineergoldmines.com.
Value from success, growth in discovery. Golden Arrow Resources is a well-funded gold-copper exploration company with proven management and prospective properties in Chile, Argentina, and Paraguay. Golden Arrow trades on the Toronto Venture Exchange, symbol GRG, on Frankfurt, symbol G6A, and the OTCQB, symbol GARWF. For more information, visit us at goldenarrowresources.com or call Sean at 778-686-0135.
Welcome back. We're speaking with Ross Kay. Ross, mortgage rates are at historical lows. Do you see current rates dropping or increasing in the near future? And is that why there might be a rush on some of these nice pricey homes out in the countryside? Mortgage rates are low. Why not pick up something maybe you've always wanted?
Yeah, well, late cycle, Jim. So late cycle. So this phenomenon that is hitting the newswaves now, it's not like we haven't seen this before, folks. Anyone who was selling real estate in the 1980s knew that around 1986, there became a drive for people to move to the country, what we called it back then. In between 86 and early 90s, there was a large movement from cities out into the, we called it the country, but it was really country subdivisions. Those subdivisions were great, big, beautiful homes that you could go out and buy for the same price you bought a substantially smaller home in the local city. So if you're willing to drive 15, 20, 25 minutes, you could have basically a mansion for the same price that you had a regular family home in in the local city. So it's not like what you're hearing reported in the news hasn't happened in the past. I personally sold dozens of homes to families that did the exact same thing in the 1980s. We were listing experts out in the country for those type of properties. Well, we were inexperienced in terms of listing a farm. We wouldn't list farms. We would refer that to one of the experts in our office. Country subdivision? No, we were pretty much experts in that field. And we commanded a high market share out there. In our local market, as high as 33% at times. So we've seen this happen before. But these are all late cycle trading patterns. These patterns happen over and over and over again. So that's no different. The greater question is that these decisions are being made now. What happens if interest rates are to rise? Because we knew the consequence of that in Ontario. Because through the early 1990s, the government continued to drop rates. They couldn't drop them quick enough, Jim, to recover the housing market. Everybody thinks that the housing market is functioning today differently than what it was functioning in the 80s and 90s before. It's not. It's functioning the exact same way. So the question on mortgage rates really is this. The Canadian economy is in a recession, and as far as we can see it, it's going to get worse. It's not going to get better. That's how we see it. Okay. All of our analysis, all of our recommendations, all of our forecasts are rooted on what we're seeing as the underlying principles in the economy. So are the ratings agents going to continue to drop Canada's credit rating? Okay. We're already hearing UBS. We're hearing Capital Economics. We're hearing all of these people talk about falling home prices. Well, falling home prices generally mean a weakening of the economy, which usually means any debt being incurred by the government has a lower chance of being repaid, which the rating agencies in turn use to downgrade your credit. You go from a AAA to a AA to maybe a single A. And when a single A happens, I don't know how a bank, the Bank of Canada, can hold interest rates low. Because generally what happens, Jim, is when the rating agencies drop the rating on the Canadian debt, the Bank of Canada has to respond by raising interest rates. They need to raise interest rates to make that debt more attractive at the higher risk that these rating agencies have placed on it. Now, if you go back and you check through the last 30 years, you're going to see this consistency happens over and over again. I don't know why they're not talking about it right now. They certainly were talking about it back in 2010. They were certainly talking about it back in 2013. They were certainly talking about it in 2015. But somehow they're not talking about it any longer. Now, it's possible that the global rating of debt is going to be downgraded, and maybe Canada will stay level, or maybe Canada will even be a little bit better because of the structure of our housing market. Because our housing market can weather a far greater storm than most other countries in the world, the way that it's structured right. So maybe that's possible. Maybe our Bank of Canada will not have to raise interest rates to offset a lowering of the risk, making of the risk greater by our rating agencies rating Canadian debt at a lower grade. If that's possible, then maybe they can hold rates where they are. But this is what the listeners really need to understand. Housing markets are reliant on declining mortgage rates at renewal. Okay, folks? That means there has been no time between 1980 until today that the housing market has weathered a period of stable interest rates. It has never happened. Every time the bank thought that they could stabilize rates or raise rates, they found out they were wrong because household consumption, household spending decreases the moment they leave rates where they are or they raise. That has happened consistently over the last 30 to 40 years. Whether the bankers realize this or not, I don't know. I mean, they're intelligent people. I'm assuming that they do. Why they don't tell people this, I don't know, but they don't tell people. But this is simply a fact of a housing market. You can't keep dropping the rate with a magnitude of change required to keep a housing market running forever. So mortgage rates are at a historical low today. 100% true. Tangerine Bank has a posted rate on a 5-year fixed term today of 1.84%. This is not a discounted rate, folks. This is a posted rate at a discount version of one of the major Canadian banks. That means one of the 6 major Canadian banks is underwriting a posted rate, a tangerine, of 1.84%. That means if you're going to get a mortgage, you should be able to go to any of the six major banks in Canada and negotiate at least a 1.84% 5-year term. If anybody tells there is a way for those rates to drop further, I don't know. I don't know the mechanism that's going to allow that to happen. Because you got to remember, even if they were to drop, say, for the sake of the argument, to 1.6, 1.4% for 5, they have to keep dropping in order for the housing market and house prices not to be impacted by it. To do that, I believe there's a reciprocity in the rating agencies dropping the rate of our debt, maybe in the single A territory. And I don't know how the Bank of Canada cannot respond to that by raising interest rates. We talked about the mortgage interest rate trap on the show, Jim, several times over the last couple of years, and this is exactly what the mortgage interest rate trap is. There is a difference between what the rating agencies are going to rate the risk of Canadian mortgage debt to what how the bank has to respond to those increases in lowering of our rating, and what the consequences on the mortgages. And the fact of the matter is, these things are interlocked. They're intertwined. You can't do one without the other happening. It's a trap. You drop rates too low. You don't let the housing bubble deflate as it was already deflating 2013 before Polars came into power, before Evan Siddell took the reins of CMHC. But those two guys combined, for whatever reason, decided to stop the deflating of Canada's housing bubble. And instead, they got in the pump and started pumping it higher. Polars is left. His heir, Tiff now, is in charge. Siddell is leaving any day. Siddell will be gone. There'll be a new person to pick up the mess. This mess is historic. I don't know how they get out of it. Gotta leave that to bigger economic minds than ours.
We'll have more with Ross Kay right after the break.
Media recognition from Bloomberg, Reuters, recycling trade publications, patented process for 100% recovery of critical metals, including cobalt, lithium, nickel, manganese, aluminum. American Manganese is focused on recycling lithium-ion batteries for electric vehicles. American Manganese trades on the TSX Venture, AMY, the US, AMYZF, and Frankfurt 2AM. For more information, visit AmericanManganeseInc.com or phone me, Larry Ray, at 778-574-4444.
Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com.
And it also included the 1st and 2nd of October. I don't care what anybody else tells you. What I can tell you is this. Trading day adjusted housing staff correctly allocating sales each month for every MLS association across Canada, each province across Canada, and nationally, from 1980 till today, add up to the exact same number of sales that have been reported by organized real estate. The only difference is those sales are allocated to the proper month in which they took place. Real estate boards have sacrificial months and they have beneficial. There are generally 4, 6 sacrificial months in a year, and there are generally 5 to 7 beneficial, 6 to 8 beneficial months in a year. Real estate agents take the hit 1 month, and they get the benefit the next. Strategically using those reporting days to their advantage. The spin they put on the market is amazing. That's why, right now, across Canada, Calgary had flat year-over-year sales in August, and they had a massive 26% increase in September. That's right. Flat, up, flat, up. Beautiful to watch. You've never had this opportunity to see it before. And unless you knew how real estate boards work, how the MLS reporting rules work, how your local real estate boards report the stats, and the behavior patterns of real estate agents who make a sale, never know what I just told you.
Ross, thank you so much for chatting with us.
Thanks for having me on, Jim.
My guest has been home ownership consultant Ross Kay from thewealthyhomeowner.ca. If you have any questions for Ross, you can send them to info@HowStreet.com. Find us on Twitter @HowStreet, our YouTube channel, Talk Digital Network. We're also on Facebook. I'm Jim Goddard. Thank you for listening.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.